Hello, Metastock users, and welcome to this first video in our six-part educational series from GoNoGo Charts. My name is Tyler Wood. I am a CMT charter holder, and as always, I am joined by my dear friend, Alex Cole. How are you today?
I'm very well, thanks.
Excellent. So thank you all for tuning into this. What we're going to cover today are some very basic concepts in technical analysis, and for trend-following investors, this might feel somewhat familiar. But we're going to talk about a lot of the difficulties in using a multi-factor model or many indicators on our charts, and how we might simplify our process in order to reduce analysis paralysis and just get to the information, not the deluge of data. So as we developed these tools, Alex and I have worked together for well over a decade, educating folks in the toolkit of technical analysis. And we came to understand from some of the best research analysts and money managers in the business that what they have formed over years is a disciplined, repeatable process, which means that they're going to trade with the exact same rules, whether they're in a bear market or a bull market. And the trades might look different, and the time period might look different for those trades, but they are not succumbing to the fear and greed that is inherent in all of us human beings as investors. So we want a repeatable process that we can lean back on every time there is uncertainty in the markets. Now, to help illustrate this point, we've got a little metaphor to share with you. For those of you in the tri-state area of New York City, Alex Cole has a teenage son who's learning to drive. So let this be the first lesson in risk management. Maybe stay off the roads for a little while he gets comfortable behind the wheel. But when you think about learning to drive or learning any process or tools, you want to have a checklist. The items or the activities or actions that you're going to take in the exact same order, in the exact same way, every time you approach this inherently risky activity. So in the case of Alex's son learning to drive, we want to make sure that he's wearing a seatbelt, that he has his foot on the brake before he turns on the car or engages the gears. We want to make sure that he knows how to use turn signals and that he's checking his mirrors to make sure he understands where traffic is when he's entering a freeway. And then, of course, we're going to make sure that he knows how to regulate speed on the highways and keep up with traffic and not endanger any of the other drivers or himself. So think about that metaphor, that checklist, that rules-based approach. Before you even get in the car as a trader, before you even open your account and start looking at your portfolio, you want to have your process or your checklist already predefined. You don't want to just react to whatever grabs your emotional instinct every day in the markets. And you might use technical analysis to help keep you on the right side of those trends. Now, technical analysis is this big, beautiful body of knowledge. And so your checklist might include things like Dow theory. That's 130 years ago. Charles H. Dow helped us understand that the indices discount everything, that there's this idea of confirmation between the indices. You might look at some trend lines. You might look at some basic moving averages, trying to understand where price is relative to its historical mean. You might look at pattern recognition. Some great work by Edwards and McGee done in the 1930s. This is way before the advent of computing power, and just looking at price behavior itself can be really powerful. You might look for areas of support and resistance on your chart to identify areas of key resistance or support, setting some stops, and the list goes on and on. Now, what we'd like to do in this very first session is just walk through what a fairly simple approach or checklist might be, identifying trends in any security across any time frame. So, Professor Cole, if you wouldn't mind, why don't we walk through what a responsible, fairly simplistic checklist might look like?
Yeah, and I think the most important part of what we do is trying to identify trends, because that's arguably the most important skill. So as we build this checklist, let's think about how it helps us understand the direction of trend. Because if we can identify those trends, then of course we can profit in the majority of the move. And we like to say that it's simple, but it's not easy to do. The concept is simple. Find securities that are going up, right? That was the craze during the TikTok trader revolution, right? Just buy things that are going up. Well, of course, it's a simple concept, but not easy to do. Now, what we might do to begin with, Tyler, is just eyeball the chart. And you might take a look at a chart and sort of ask yourself, is it moving from the bottom left to the top right? Is it starting to make a series of higher highs and higher lows? Because, of course, that's how we determine a trend. But at what point do we start to see these new highs? What point do we say that the lowest low has been set and now we're looking at higher lows and higher highs? So we might want to automate that process. So the first sort of technical study that we might use is something like the Donchian channels. If anybody's familiar with the turtle trader experiment, an amazing story about Richard Dennis, who felt like he could create turtles. He could breed traders, just like they did turtles in the turtle farms that he'd seen on his travels. And so what he did was he tried to give his traders tools to use to make it clear and easy to identify change in price behavior. So Donchian channels was the main indicator that they used for their entries. And all that's doing is looking back at a certain time period and asking whether or not price is at the high or the high is the high for that period. So, of course, when it is the high, then you'll put the lines on the chart to reflect that. So you can see that red line there. When that line moves up, we're saying that price is higher than it has been for the period we're looking at. So every time price makes a new high, let's say we're looking back over 20 periods, every time price is as high as it's been in that 20 periods, we're going to move that red line up and we're going to be able to visually identify highs moving higher. And of course, the same on the bottom, the green line would reflect lows moving higher or lows moving lower if we're in a downtrend. So the first thing we can do is just visualize those higher highs and higher lows. But we go on from there. The next thing we might want to do is take a look at something like a simple moving average. We understand as technicians that averaging the prices removes some of the noise and some of the activity that perhaps distracts us from seeing the movement of price. And so we might put a moving average on our chart. And we know that if price is trading above its moving average, that's inherently bullish, because what we're saying is that price right now is trading higher than price, the average of price over, again, a certain look back period. So there's more enthusiasm. Price is moving higher now than it has done over its past average. But of course, one moving average, two moving averages, three, we've moving average envelopes, we've seen all number of moving averages on charts. And there's sort of the idea to an extent that more moving averages will be better than one moving average. So maybe the first sort of system that we've sort of seen in technical analysis using calculated indicators was the moving average cross. So if we have two moving averages on our chart, we can look at the moments when they cross over each other to give us an indication of the likely direction of price. Think about what that means. If we're saying that the short-term moving average is crossing above the long term, that's telling us that average of prices in the short term are moving higher more quickly than the longer term price average. So that's a bullish indication, and it's a way to use that concept to trigger some sort of action. But you can move on even from here, right? That's just a couple of simple ideas on the chart. Bollinger Bands. If anybody's been looking at technical analysis for some time, you will have come across Bollinger Bands. Another great idea by one of the real leaders in our industry, John Bollinger. And what he did was look at bands around price. And in the case of Bollinger Bands, these are standard deviation bands. And what we're looking at, or what we're looking for, are interesting situations, times when something unusual is happening. We know from our previous lives taking mathematics classes that 95% of the data should be incorporated or encompassed by two standard deviations. So whenever price is outside of the bands, that's very, very significant. Now, just to note, financial data is not normally distributed, but again, the vast majority of our data should be within those bands. So when price is trading up and out of a band, that's pretty significant. So often when the bands narrow and price trades up and out of a band, that would be an indication for us to trade in the direction of the break. Something significant is happening when those bands are narrow and the price moves out of a band in one direction. So we're at what, 1, 2, 3, 4 concepts now. We can add volume, of course. Volume, very important. One of the first things used, Charles Dow used to talk about volume as being the first sort of non-price data that was very, very important. We use it as a confirmatory tool. We like to see what volume or what the market is doing when we see certain things in price. So if we see price breaking higher and it's supported by heavy volume, that's a good sign. That's showing enthusiasm. What if it's not supported by heavy volume? That might tell us something different. So we're going to throw volume on there to get a sense of the market participation around any price moves that we're seeing. And then we can keep going. Let's do one more. We've got MACD here, the moving average convergence divergence indicator. Again, a very, very popular indicator that gives us some sense of trend and momentum. This one is the difference between two moving averages. The moving averages in this case are exponential moving averages, meaning that they are a little bit more sensitive to price movements. And then we put a signal line on the panel, that red one, which is then the average of the MACD line. So we can now use that moving average cross idea to get signals from the MACD as well. So I'm going to pause and I'm going to try to look somewhere in the middle, sort of that middle chart there, where we're seeing things come together. We're seeing price above its moving average. We're seeing new Donchian channel highs. We're seeing the MACD crossing above zero, right, which is a bullish indication in itself, because we're saying that prices again in the shorter term moving higher than longer term prices. So we're starting to see somewhere in that blue oval all of the things that we've put on our checklist rationally, telling us that perhaps a new trend is going to take place in the upward direction, right? So that's where we're at the end of stepping through our list, trying to determine now when we can be confident to, if we're an analyst, when we can be confident recommending long positions, or when we can be confident that we are seeing a new trend in the up direction.
And so this process of putting the weight of the evidence on your side is very responsible, right? You're not simply a leaf in the wind to your fear and greed that takes over in your trading account. However, there's a full month worth of trading activity inside this blue oval, and deciding how many items on the checklist, at what point do you take a trade action based on that more robust set of rules and tools, can cause some problems, can reintroduce all of those behavioral impulses that we're trying to get away from. We want to remain objective and not fall victim to emotional or rational decision making. And therein lies the challenge with technical analysis that Alex and I hope to solve with GoNoGo Charts. The idea is that all of these tools are incredibly useful, powerful, very important information that we can glean from the markets. And when we get back to our trading practice, to our investment process, we need to make sure that we're using these tools in a way that doesn't cloud our charts, doesn't diminish our view of price action itself. After all, our most important indicator of all is where price is at. And we don't want that indicator overload that's going to reintroduce all of the subjectivity and the emotional decision making. So what we have done is to take all of these and many other tools and put them into our mix in the back end. But when we display the multi-factor model, the algorithm, if you will, we want to see it back in a chart, not in a black box, not in a situation where we don't know how it's reacting to markets, but in a data visualization method that simplifies our view, but gives us all of that confidence that the weight of the evidence is in our favor. So the solution from GoNoGo Charts is this very first indicator, the GoNoGo trend. And it's blending all of those robust, tried and true, heavily back-tested technical indicators in the background, and with the weighting of all of those tools showing us trend direction and trend strength by simply color coding the chart. So as we look at a GoNoGo trend chart, we know that when we are in aqua and blue conditions, that's our weak and strong form of a go trend. The very name of the company refers to like a NASA shuttle launch. If you are go for launch, that means the conditions are optimal. And if you think about NASA, they don't want to throw billions of dollars of hardware into space unless they know that they have a great chance of success. So when the conditions are optimal, a go for launch, a go trend is in the upward direction, and it can be strong or weak form. Similarly, a no-go trend, or a trend in the downward direction, can be strong form in these purple bars, or a weak form of the no-go trend conditions in the pink bars. And you may notice that in these periods of transition, we sometimes see amber bars. We know that markets can move up, down, or sideways, and it's that third condition that is a signal in and of itself. When all of the factors in our model are in their neutral territory, when they're all in their zero levels, we know that the market is showing some signs of indecision or uncertainty. There's not enough evidence to denote a trend in one direction or the other. And as Alex and I are very fond of the life and work of Jesse Livermore, we're reminded of his famous quote, which is that in all markets, there's a time to go long, a time to go short, and a time to just go fishing. So those are the go fish bars when you're looking at these charts. Now, Alex and I are so proud of this work. We just want to give it away. And so for all of you who use Metastock, you can apply this template, the GoNoGo trend template, right to your charts absolutely for free. All we would ask is that you let us know how it's working for you. What time frame are you trading in? What securities do you like to trade? Has it simplified your decision-making process? Do you use it in conjunction with other tools like Fibonacci extensions and retracements? Or maybe you have a fundamental process and you just look for trend as a final confirmation on your security selection. So if you have any feedback for us, you can reach out info@GoNoGoCharts.com. Thanks so much for sticking with us. This is episode 1 of our 6-part educational series, and we'll see you right back here for episode 2.